So it's a pleasure to be here today with Danny Masters from CoinShares. My name is Garrick Hileman. I'm the head of research at blockchain.com. And let's just jump right into it. We're here to talk about gold. Danny,
Sure.
Why don't you, if you don't mind, start by just introducing yourself and CoinShares.
Yeah, well, thanks, Garrick, and appreciate you and Coinscrum setting this up. So I'm the chairman of CoinShares. CoinShares is a multifunctional digital asset management company. We have passive exchange-traded products. We on NASDAQ, OMX in Sweden, some other exchange listings. We have funds. We have gold token, which I think we'll be talking about today. We have an index product, and we support that product suite with various other functions, including a very active trading business, CoinShares Capital Markets, custody business, Kimenu, which we do in joint venture with Nomura and Ledger, and also research functions that get a very wide reading and good audience that cover such things as mining, individual coins, multi-coins, all coins, and so on.
Great. So you mentioned gold and our product DGLD. I think first thing we should just disclose, of course, is that CoinShares and blockchain have a partnership around the DGLD token. And so I think it's important for listeners to be aware of that as we talk about gold and some of the competing ways of owning gold, including other tokens. But maybe we could just start with the kind of investment case for gold in general, and particularly for our cryptocurrency audience. We'll get into in more detail maybe gold versus Bitcoin later.
For the cryptocurrency investor, I'm sure, like me, you are an active cryptocurrency investor, as will be many of the audience members. And, we're used to very, very high volatility. We're used to experimental kind of products and new networks. And I think many of us have been fortunate to be involved in some of the more successful ones, although we're all been involved in some of the less successful ones as well. But fundamentally, I think you can view the cryptocurrency, activity as having sort of two legs. One leg is I'm exposed to cryptocurrency. Now that can be in your wallet, it can be in cold storage, it could be on blockchain.com exchange, or many other variables. And then you've got, when I'm not in cryptocurrency, and in that sense, there are a number of other options. You could cash out your cryptocurrency and withdraw the money into a regular bank account. You can flip into another form of stablecoin, USDT, USDC, Gemini coin, and so on. Or indeed, you, as in our case, can seek out a stable coin backed by some other asset. And so obviously that's where DGLD and gold tokens sit. The premise, I think, is, look, let's be honest, there are many very effective ways of trading gold through ETFs, through physical gold, through gold futures, through gold swaps. Even apps like Robinhood and Revolut now have sort of a gold tracking kind of instrument that you can very easily buy. But I think the gold, the idea for a cryptocurrency investor in a general sense is, here I am, I'm trying to get out of the volatility of crypto and into something more stable. So the question then becomes, what and how do you do that? And my feeling about gold, and I think as the blog post that you forwarded me earlier, I'm sure you'll send to the audience, it's extremely good. Details quite a buoyant picture for, I think it alludes to that for stable coins in general, but also for gold coins. And particularly for gold coins, I think for the cryptocurrency investor, when you're used to trading Bitcoin or you're used to trading Ethereum and, you've experienced volatility of upwards of 150% annualized, when you're getting out of risk, you're getting out of risk down to something that's much less volatile. Now, gold has an annualized volatility of about 6 or 8%. maybe a little heightened at the moment, but that would be the long-term average. And by definition, dollars, pounds, euros, yen, renminbi basically have 0% volatility depending on what your base currency is. But when you're looking down at low vol from the lofty altitude of 120, 150%, whether you are getting into something with 0 vol, 2 vol, or 8 vol is really immaterial. You know, you're getting out of the really volatile stuff into something less volatile. And I think, so that's kind of rationale number one. Here's a way to book your profits, avoid a downturn, avoid your risk, and park your capital somewhere else. Now, obviously with a gold token, the benefit to a cryptocurrency investor is that instrument's available on the exchange or within the wallet that you're currently using, and you don't have to take that Bitcoin out, sell it for dollars, and go buy an ETF. So, you know, for the cryptocurrency investor, you're within that framework. And then the second reason I think is, you know, there's two more layers to this. One is we can all see, you know, what's going on, you know, with the Fed right now. You can look at the Fed balance sheet. The Fed balance sheet, which sort of crept its way up to about $4 trillion, you know, after the world financial crisis, and was very, very slowly starting to decline the sort of in the fall and the winter of last year. That balance sheet has now absolutely exploded, and that will top out somewhere probably around $20 trillion. And if you look at the, you know, the decline that we eked out over a number of years to bring that balance sheet down from maybe 4 to 3, you know, we've just blown the doors off. And not only that, but every other central bank in the world, from Bank of Canada, the Bank of New Zealand, Australian Central Bank, British Bank of England, you know, European Central Bank, everybody has just ballooned these balance sheets. Now let's just think about what that really means. No one's ever proven that you, once QE is out, you know, it's a bit like the genie in the bottle. You know, you can't get it back in, because what you need to do to get it back in is you need to tighten monetary conditions. And when you tighten monetary conditions, whether you're selling out bonds that you bought, which, you know, bond selling, higher rates, probably in the longer end of the curve, or you're raising short-term interest rates, rates higher in the short end of the curve. Add that to the ballooning, you know, commercial, government, and private debt burden that the world is suffering under, and those rate increases are politically untenable. And you saw the first kind of real tangible instances of this when Donald Trump called out Governor Powell of the Federal Reserve towards the end of last year and was saying, you know, hey, what are you doing? Interest rates are too high. You need to lower rates, lower rates, lower rates. And all he was trying to do at the time was rein in this QE. So the genie's out of the bottle. And let's put this in really simple terms. I mean, you talk about QE at central banks, it sounds confusing. But in simple terms, it's this. When you create more money, right, that money is just a denominator for the goods and services that are available on the planet. And that's a double-edged, a double whammy in this case, because you're creating more money, much more money, while the base load of goods and services are actually shrinking. And this is very, very dangerous in my view. It's very dangerous for fiat money. And there are many examples of fiat money that have failed dramatically for exactly that reason. In fact, if you go back to the Weimar Republic, probably the greatest ever example of a currency sort of imploding, you know, the detail behind that event was that the German government, after the First World War, were very reticent about paying the reparations that the Allies were demanding. Germany went on strike. But the government decided to keep paying people anyway, which is eerily reminiscent of what's going on right now. And that got out of control. It got out of control, and the Weimark, the Deutsche Mark of the Weimar Republic, you know, went through a hyperinflationary phase. So anyway, back to our cryptocurrency investors investing in gold. The first question you have to ask is, if you're getting out of cryptocurrency, do you want to be in dollars at all? Because there is a headwind in that dollar holding, which means that your dollars are essentially being diluted. You are being diluted as a shareholder of dollars by this enormous QE. So that's number one. Number two, if you do make the decision as a cryptocurrency investor to be invested in fiat, notwithstanding these effects of QE, then how do you want to do that? Well, you can take that money out of a bank, as you know, and put it in a bank, like we said before. But if you choose to buy, you know, USDC, USDT, Gemini coin, and so on, you face another risk. And I'm not trying to be alarmist. I'm not, you know, an anarchist. I'm not a doomsayer at all. But you know, I'm actually talking to you from my residence here on the island of Cyprus, and it wasn't so long ago that Cyprus had a financial crisis, and the Cypriot government removed all balances in people's bank account in excess of 100,000 euros. So if you had 10 million euros, you were left with 100,000 euros. And I don't think, you know, we can rule that out when you look at ways that we are going to perhaps try to pay for the enormous subsidies that are being handed out left, right, and centre at the moment. And so, you know, I hate to tell our listeners this, but the fact is that, and with no disrespect to my stablecoin colleagues, you know, I think a dollar stablecoin is lipstick on a bank. And the fact is that every transaction does have to clear a bank, and all the balances are held in banks. And therefore, if that bank, like all banks, suffers some sort of macro haircut or wealth tax or something of that nature, which you cannot rule out at this point, then those coins are going to deflate, and they're going to deflate exactly in proportion with whatever haircut you get. So that's the second layer. And what's cool about gold in general, and cool about gold tokens in particular, is that gold is such a unique commodity, and because of its long history, and because of the way it's become an international sort of clearing asset for central banks when they, you know, borrow and lend to each other, gold exists entirely outside of the banking system. And banking regulation and financial services regulation in general, so long as the gold you're talking about is of a certain kind and allocated in a certain way, that gold escapes all central bank, governmental and regulatory policy. And therefore, it really is the most secure and stable form of value that's currently available in the environment we're looking at.
Great. Thanks for that detailed explanation there. And you know, thanks for also mentioning the report, which we'll be publishing soon here, more officially on gold. It's a 30-page research report that gets into some of the points you made, in particular the growing adoption amongst many central banks of gold, which is interesting. Rising powers like China, India, Turkey have been building their gold positions in recent years. And this is one of the things we highlight as one of the big kind of distinctions between gold and crypto assets like Bitcoin, is the fact that gold is much more mature, more established, and widely owned by central banks, and has been proposed as recently as the last great a possible new Bretton Woods II style system. Zola, president of the World Bank, 2010, just, you know, still in the early days after the financial crisis, published an article in the FT advocating for exactly that. And so, you know, as a hard asset can restore credibility to money, you know, there's an argument that, you know, central banks and institutions, because they own a lot of it, would look first at something like, say, gold. If they had to go there, there would be a lot of opposition amongst many economists and others to kind of going back to gold standard. But if they had to, they would probably turn first to gold, arguably over, say, something like Bitcoin or some crypto asset they don't have a strong holding in. In your view, is there still an argument for owning physical? You know, you've taken this step to say, okay, I'm going to, you know, move beyond crypto assets and stocks and own some gold. And I'm interested in owning, you know, a digital version of gold. Is there still a good argument for owning physical gold as a complement to your digital or ETF?
You mean in physical form?
In physical form,
pure
yes.
Physical form. Well, let's analyze that. Let's analyze that. So a really good gold vault would be one operated, you know, by a sound, you know, very reputable third party. It would be one where there's very little slippage in terms of either acquiring your gold, you know, getting your gold out of that vault, putting gold into that vault. And what you find, and certainly, you know, the gold, for example, that backs DGLD, this gold is in 400-ounce bar denomination. So each bar is about $800,000 now. And that's not really, you know, a workable situation for your average investor. Now, there are lots of smaller gold formats, but again, once you get into the small gold formats, 1 ounce, 10 ounces, 100 ounces, you find that's essentially a retail product from a gold supplier. There'll be quite a big markup on that. It could be 5, could be 10, could be 20% of value. So the benefit of actually holding the gold in the form of a token in this way is you can hold a small amount without paying this enormous VIG that you need to, while still benefiting from absolutely best-in-class, low-friction, insured, robust, reputable storage. So there is, so I think there are really big advantages. Now, look, if you are fortunate enough to, have $4 million lying around and you want to buy 5 big bars of gold, and you will find a very efficient way to put them in a vault. Someone will charge you probably 20 to 30 basis points a year to vault it and insure it for you. And you can do that, but that's a very small number of people. I'm addressing a marketplace here when we're talking that really, could be essentially the retail ETF market, right? So someone's got $10,000, $20,000, $30,000 worth of a gold ETF. That's their, low volatility disaster scenario hedge. Well, now they can own physical Swiss allocated gold, basically for the same economics as someone that's buying 5 million of physical. So it does give that access to allow people to do that. Mm-hmm. What we're also finding, Garrick, which is interesting, is people who even own vaulted. So that second class of people who are fortunate enough to have multiple bars of their own, they're tokenizing them too, because all of a sudden, their gold is there anyway. And now they have a liquid and tradable form of it. If they want to optimize, they can actually make payments with it. They can swap it for cryptocurrency on blockchain.com exchange. And it gives them a little extra flexibility. And in fact, I would tell you that a lot of the gold that we have on our token scheme is people that have done that. So it actually works both ways.
Yeah. We've seen, a much stronger, more positive correlation between gold and Bitcoin recently. Given the macro environment, they're moving more closely together than they have historically. So that's, I think, one question that's on people's mind. Are we, should we expect to see that, more and more as we go forward? And then really, a lot of people look at, Bitcoin, of course, is a more volatile hard asset than gold, but it arguably has more upside. It's less widely adopted and can be used for all sorts of things that gold can't be. You've got companies like Microsoft maybe anchoring a digital identity system to the Bitcoin blockchain. And so I think maybe a lot of cryptocurrency investors are still a little hesitant or don't see the point of owning gold if they already own something like Bitcoin. And so I think it'd be worth kind of spending a little more time on that, the correlation, and also kind of, what we should expect going forward, and why cryptocurrency investors maybe should think more about gold than they have historically.
Yeah. Well, to your first point, the correlation between gold and Bitcoin, that correlation was picking up and had become quite powerful in the early stages of the economic unwind that we're doing, and before, during the trade, the potential China trade war and so on. We did start to see a very interesting correlation between gold and Bitcoin. And I was getting quite bullish about that because, Bitcoin is like, if Bitcoin does give you that portfolio diversification that gold does, you actually need a lot less Bitcoin than you need gold, just because of its natural volatility. And it's also, also got some, anti-correlation benefits, within a portfolio, even side by side with gold. Because while they may not be correlated to, stocks and bonds, even gold and Bitcoin have their movements. And when you can decrease correlation, even if you don't make any excess return, you're increasing the Sharpe ratio of your portfolio. So that looked pretty good. The unfortunate thing, I think, that we need to be honest about is that we had sort of Black Monday in crypto when we dropped from 7,500 to 3,500 in one day, as the crisis really began to break out. And the simple reason for that, and you can see it on the blockchain, there was a lot of relatively new wallets, a lot of relatively new holders who had bought probably at an unfortunate moment, maybe had to liquidate because of other issues in their investment portfolio or leverage or margin calls. and we had a pretty bad day. And I think that kind of punctured that bubble to a certain extent. Now, since then, it's kind of been reestablishing itself. And I think one of the things you have to be realistic about is, you can leverage a gold position pretty well. You can go and buy CME gold futures, today's volatility environment. You probably get 4-to-1 leverage in an average account, but that's nothing compared to 100-to-1 leverage you can get on many cryptocurrency derivative exchanges. And so we'd left a little bit of a landmine in the Bitcoin space underneath the marketplace, where I think people were buying, maybe ahead of the halving that's coming up in a couple of weeks. They bought already, a month ago. They levered 5-to-1, 10-to-1, 20-to-1, and we have a big down impulse in price, and that triggered a lot of stops, and that did some damage. That argument was, I think, temporarily punctured, but I think gold does come back as a good thing side by side for an investor that has a broader portfolio of currencies, stocks, and bonds. And again, just for the crypto investor, personally, I'm increasingly, when I'm rotating out of crypto, I'm increasingly using and thinking of using more gold-backed tokens for the reasons we said before. I'm not thrilled about the way the dollar looks. I'm not thrilled about the way the banking system looks. And I'm not thrilled about the fact that every time I do a USDT or a bank transaction directly, my money's sitting out there at the bank. And, if one day the music stops, I don't really want to be there. So I think those are the key thoughts that cryptocurrency investors should have.
That's something that's quite, I think, new in the history of gold, that tokenization potentially offers and could be interesting in a world where stablecoins in a negative rates environment, may not be, viable, or certainly run into real pressures that they haven't.
Yeah, look, you raise a bunch of really good points there. Just to address the first one, in terms of go-to-market strategy, we talked about the ETF buyers and the crypto investors as two classes of go-to-market. There's a third one, like you point out. It's the guy living in Brazil, Venezuela, Nigeria, where the currencies are under extreme pressure at the moment. I mean, probably the untold story of this crisis as we're going through it is how badly emerging markets are being beaten up. Brazil fell off a cliff last Friday. South African rand has been absolutely tanking. The Turkish lira is under a tremendous amount of pressure as well. And I don't think we've seen the end of that. In fact, you could argue that even as we come out of lockdown, the effects, pressures in the financial system will hurt emerging markets even more. Raoul Paul put a great piece out called The Dollar Wrecking Ball last week that I recommend people go look at in that regard. So, but yeah, look, we're working on some interoperability for DGLD. I realize the other tokens are already interoperable. There are some nuances there, but certainly, with a wallet infrastructure as big as blockchain.com's, why couldn't a currency that's under pressure, or a country that has a currency that's under pressure, kind of, either explicitly or implicitly see that gold-backed currency becoming much more viable? So that's one thing. Your second point about negative interest rates, it's extremely, extremely relevant. And let me just bring a few things into play. Number one, go check out Mervyn Goodfriend, a fellow of Carnegie Mellon University, former governor of the Federal Reserve, board member of the Federal Reserve. He wrote about this 5 years ago, talking about the zero interest rate bound and how physical money can't support interest rates below zero, because everyone's going to say, well, I leave my money in the bank, I get 95 cents at the end of the year, or I take it out and I stick it on my mattress, and I don't. So he actually started talking about stable coins effectively. He didn't know he was, but it was stablecoin at that point. And that ZERP, as they call it, is really important. So that's great reading. And also, obviously, central bank digital currencies bring in real-time accounting, lack of, stamps out the black market. There's surveillance, good or bad, around currencies. It's very, very powerful. And I think the fact the Chinese are now road testing a digital currency is really going to advance that argument. And so that specter of, on the one hand, China's going to eat your lunch and use a digital currency for international finance, and on the other hand, how am I going to impose negative interest rates, which are a real possibility? That speaks volumes to digital currencies. But those digital currencies may well come with a haircut, and that's where a gold token actually has a tremendous potential as a currency. And it's almost like a whole parallel new universe is creating. Beforehand, we had fiat money in banks and gold, and now you may have Bitcoin, and central bank digital currencies, and they'll form the same kind of pairing of fiat and gold, Bitcoin and CBDC. And in a world where there's lots of CBDCs, Bitcoin doesn't look so strange to a lot of people. You can see Libra, the Libra Foundation, when they redid their white paper, much more along those lines of being, single currency stable coins. So this is all connected. Negative rates, the retail adoption of coins and wallets, the central bank digital currencies. This is all going to come into play, I think, in the next 12 months.
Great. Well, we're just about out of time here. I guess maybe a last question, and I know this is hard to provide a general answer to, but imagine you're a cryptocurrency owner. You do want to gain some exposure to gold. You own some Bitcoin as a hard asset, as a macro hedge. How should someone think about this from a portfolio perspective in terms of owning X amount of percentage of Bitcoin vis-a-vis gold? What's a good framework to begin to kind of think through that question?
Yeah, look, I mean, I think I come from the commodity space. When I started, in the mid '80s, there wasn't an investment thesis behind commodities, and that investment thesis grew over 20, 25 years and really turned the corner when it came to the Goldman Sachs Commodity Index. And what the Goldman Sachs Commodity Index really showed was that there was portfolio uplift for a portfolio of stocks and bonds when you added commodities. And those sort of allocations, for a bigger portfolio, for institutional portfolio, you might be talking about 0.5 to 300, but 0.5%, 50 basis points to 300 basis points of an allocation. Now, that's a huge number. Don't forget, if that's of the world's investment population, asset population, that's a huge number. Even if it's a shifting of that kind of allocation from gold into Bitcoin. So let's suppose you've got your 5% gold allocation, but you want 20% of your gold allocation to be Bitcoin. Given the fact that, gold's an $8 trillion market and Bitcoin's $120-30 billion market, that's a big number too. So I think you're talking, a handful of percent terms in terms of an overall portfolio. But a lot of people that invest in gold and Bitcoin are trading it. They're buying it because, they want to make a good return. And to those people, I'd say, look, to me, you're trading gold and Bitcoin. You're trading the same idea in two different forms. One's highly volatile and quite risky. One's much less volatile and less risky. And it also happens to be a good place to park your Bitcoin when you're not in Bitcoin. So those two, come into a bucket. And, my personal feeling at the moment is that it's sort of a technical issue. What we're seeing in Bitcoin at the moment is that the big spikes are getting quickly sold. And I think part of the reason for that is there's still so much leverage available that when people see a little pop, everybody jumps in 20x and tries to make, a quick $2,000 in Bitcoin. And that's why you see these little spikes up followed by big spikes down. But I think what's actually going to happen in Bitcoin, it's going to go in a shallow uptrend. And so I do feel like, the outsized returns of 20-30% in a day that you've seen in Bitcoin in the past, while they're both profitable potentially, but risky also, and quite alluring to investors, I think it's going to be much less of that going forward and a much more of a steady flow, gently upwards, punctuated by some of these, leverage-based pops. And on that basis, look, I think from a trading portfolio, as I said, gold is a little bit boring, but I'd be oscillating between, I always want to have some Bitcoin for sure, because I can't quite shake that idea it will explode one day upwards. But let's say that then, and that might be 80-20 to 20-80 over a period of time, just flipping between those two.
Great. Excellent. Okay. Well, I think we've hit the end of our time here. Again, if you have more questions about gold-backed tokens, the case for Bitcoin versus gold, come check out the blockchain.com research page or our blog where we're publishing this nearly 30-page report with lots of data and information. I want to thank Danny again for coming on, sharing his thoughts on this topic, and we'll look forward to hopefully seeing you again in the near future.
All right, Garrick. Thanks very much indeed. I appreciate it.
Hi, I'm Charlie McGarraugh, the head of markets at blockchain.com, the world's most trusted crypto company. got a quick recap of recent action in the crypto markets for your thinking and enjoyment. Let's dig right in. So, recent trends in the markets. A couple of big things happening. Really, the defining moment of the last 2 months in crypto trading was the meltdown in March, and the market's subsequent recovery and working off the hangover for that. We've seen basically low volatility on the way back to kind of the pre-implosion levels. And that's kind of come in the context of a market that's delevered and at more reasonable conditions in terms of the OTC lending market, which we'll dig into a bit more. From a technical perspective, we're kind of back to the top of the recent range. And while a few indicators are kind of flashing yellow, my own view is that perhaps this is signifying enough strength to manifest a greater breakout, but only time will tell. In terms of on-chain metrics, which we'll only touch on very briefly because others later on may have more to say about that, we have seen, I think, nothing that looks overly concerning. And a look back does validate the idea that there was, distressed stop lossing in March, which won't come as a surprise to anyone. And then we'll discuss a bit more about what more to look for in the coming weeks. Okay. Firstly, here's a little chart of realized volatility over different time horizons, and what we can see is that short-dated volatility in Bitcoin went as high as 220%. That's a 10-day rolling vol, and has now backed down to the baseline basically before the market had its big moment. And so volatility is really kind of back down, and these longer indicators of volatility, which are just longer rolling windows, are also saying the same thing basically, which is it's elevated, but as the crash comes out of the look back window, that will also revert back to baseline, assuming nothing new happens in the market, which is always possible. So, okay. Secondly, the sell-off in March has, I think, caused some questioning of the broader investment narratives for Bitcoin in the market. Gold has massively outperformed this year as global growth gets re-rated downward, and Bitcoin, which is our leading contender for the future of hard money, has really not kept pace, kind of on a relative performance basis. Now, obviously, Bitcoin's a lot more volatile and there's a lot more going on, but during the crash, gold and Bitcoin all sold off as market participants just deleveraged in general. Gold has bounced back, and Bitcoin has bounced back less, I would say, kind of on a relative basis relative to its recent ranges. I think the other thing that's really quite notable to see here is that the Bitcoin market started underperforming even as gold was outperforming before the big crash, which probably shook the confidence of some crossover market participants. Here again, though, it's too soon to declare Bitcoin dead as a macro hedge, and what we see actually is that CME open interest is actually back to the highs. So somebody out there in institutional world is still playing the game, presumably at least partially from the long side, and that's keeping track back to the highs, even though we're nowhere close back to the highs in Bitcoin. So maybe the smart money's buying, or maybe people are just chasing a story that doesn't work anymore. In terms of macro conditions, one of the indicators I quite like to use is the ratio of gold to copper. Gold is kind of anti-growth. Copper is, obviously a great proxy for global industrial production. And what we're seeing is that the gold-copper ratio has kind of at the highs, but having a hard time breaking out to go any higher as the market's gotten a bit more optimistic as stocks have bounced back. And Bitcoin, which, maybe, should be tracking this as a sort of, if the digital gold narrative is the dominant narrative, has really underperformed. On the crypto lending market, where to from here? I guess we've seen a huge deleveraging amongst OTC lending participants, and that was really manifested in the shape of the curves in futures changing, and Bitcoin getting much more expensive to borrow relative to dollars at the height of the sell-off, which is very interesting because the rest of the world system, dollars got very precious, and then the Bitcoin system, even as the Bitcoin price sold off, it got very hard to borrow Bitcoin because Bitcoin is the the working capital that is used to transfer between venues and provide working liquidity for market participants. So same theme that drove dollar tightness in other markets, basically a squeeze on working capital across the system. Underwriting standards are now a bit more conservative. And we are starting to see basically a return to an upward sloping futures curve after being backwardated pretty heavily. I would imagine that continues and dollars get a bit more scarce in the ecosystem, but the dollar market probably needs to rally, the Bitcoin price probably needs to rally quite a bit more before dollars become scarce enough that the dollar borrows really tighten up and the dollar yields for collateralized with Bitcoin really go high, and those futures curves go into a big steepness. So right now it looks kind of more like steady as she goes. Market pricing is fair, and it doesn't feel like either crypto or fiat are scarce inside the ecosystem at the moment. From a technical perspective, using Fibonacci retracements over the last year, 8,900 and 6,250 are kind of the big levels to the top side and downside respectively. We're kind of in the middle of that, and threatening the 200-day kind of up in the low mid 8,000s, and so Bitcoin looks like it's manifesting an uptrend, but it won't really be confirmed until we've taken out the 200-day and then cracked 8,900 conclusively to define like basically a new trading range. Using Bollinger Bands, the market does look like it's a little bit toppy here. The Bollinger Band channel has tightened massively on the back of the decline in realized volatility. But if you look at the next chart, which is the RSI, we don't appear to be overbought yet, so we can go a lot more. I guess my own working theory is that we're about to break out of the Bollinger Band into the halvening, and then the RSI can get materially more overbought than it is now. And I think the lack of leverage buildup in the system with low futures open interest on the derivative exchanges and so forth is also sort of lending some credence to that idea. The market certainly has capacity to go for more versus where we're at right now, despite kind of being at the top of the channel. And I would expect basically that happens less with the channel break on the Bollinger Band, but more around an uptick in volatility that then sort of justifies like a wider range and higher prices. In terms of on-chain activity, what we saw was basically the average seller moving Bitcoin at a loss versus their historic price in the middle of March. And now we're kind of just kind of back to business as usual. This average seller realized profit would have to be a bit higher here in the kind of $200 per Bitcoin to signal kind of we're at closer to the end of an uptrend. So it's just sort of confirming trend extension to the top side for now is kind of my view. But that's just an opinion, and all opinions are subject to change at a moment's notice, especially in crypto, as we all know. It's always quite risky. Right. Okay, other themes that bear watching. Sorry, I had a bit of a slide problem there. Okay, other themes that bear watching over the coming weeks. Facebook and Libra having changed the architecture to be single currency backed is certainly interesting and could potentially provide more on-ramps into the space. China's digital currency is also another thing to watch with the evolution of the ecosystem. Stable coins, Tether's been growing on an ongoing basis, and that has probably contributed to less scarcity of dollars in the system. But at north of 7 billion now, it's really something to behold, and the market seems to be maturing on that side. Interestingly, thematically, the use of digital wallets for getting COVID-19 support to consumer and small business endpoints, I don't think we've heard the last of that, and that'll be a space to watch. Obviously, there's a lot of policy consideration there too, but that'll be a really interesting one. And then finally, on altcoins, there's still lots of work being done on DeFi, Ethereum, and the other Ethereum smart contracting protocol competitors. Lots of work on that, and definitely something to watch. And I'll leave you with this on that last point. Ethereum has sort of outpaced Bitcoin on the way back up here, with ETH BTC kind of back toward the higher end of the recent range. Definitely something to watch. If we're seeing an altcoin outperformance in the context of an uptrend, maybe the story isn't so much digital gold as just broader retail participation in crypto with the advent of the lockdowns, and that's certainly something to watch. I think if you do see an altcoin led further extension, I think it will confirm a broader based participation in inflows into the ecosystem and argue for greater trend extension overall. That's it for me. Thanks very much for taking the time.
Thanks, Charlie. Welcome to Onchain Reaction. I'm Philip Gradwell, the Chief Economist at Chainalysis, and I'm going to be taking you through the on-chain data behind cryptocurrency markets over the last couple of weeks. In particular, we're focusing on the 13th to the 26th of April. And in that time, the Bitcoin price has risen significantly, in particular on the 16th and the 23rd of April. So what was actually happening on the blockchain at that time? Well, we've seen some very large inflows of Bitcoin to exchanges on the days prior to that price increase. And that's actually unusual. When we see these large inflows of Bitcoin to exchanges, we expect that Bitcoin to be sold and therefore the price to fall. This time round, we saw the price increase. Now, why might that be? Well, we have heard that there were large amounts of fiat sitting on exchanges waiting to buy Bitcoin. So perhaps when they saw the price start to move and they saw this extra liquidity enter the market, that was seen as a signal to buy. And actually that waiting demand that was on the sidelines has actually helped buoy up prices. Also interesting to see in this chart the effect of the weekend. Inflows to exchanges are much higher Monday to Friday, and they really drop on Saturday and Sunday. So we can see that actually a lot of people involved in crypto do it as their day job. What else can we see from the flows of Bitcoin to exchanges? Well, we can look at the flows of Bitcoin between different types of exchanges. Crypto to crypto exchanges, crypto to fiat exchanges, where you can sell your crypto for dollars or pounds or euros, and then the derivatives only exchanges. And last week, the interesting thing for me was that there was a net flow of $158 million from crypto to crypto exchanges to crypto to fiat exchanges. Now, how can we see that? Well, there was a flow of $452 million from crypto to crypto exchanges to crypto to fiat exchanges, and a flow of $294 million the other way, giving this net flow of $158 million. Also interesting is that there was a net flow to derivatives exchanges, so more money entered derivatives exchanges than left last week. We can also look at the flows of Bitcoin between different geographies. Now, we're able to do this by analyzing the time zone patterns and other open source intelligence such as web traffic of cryptocurrency businesses to understand the regions of the world where their customers are likely to be. Breaking the world up into 3 regions, Eastern Asia, North America, and rest of the world, we see that in the last week, most of the activity was actually within the regions. So people within Eastern Asia were largely sending to people also in Eastern Asia. There's $350 million flowing within that region in Bitcoin alone. Next up was North America, sending to North America, and then the rest of the world to the rest of the world. And that's actually kind of strange. Normally, we see larger flows between the regions. So the story of last week is perhaps about action in local markets. But Bitcoin was not the only story. Tether has also been interesting recently. Tether flows into exchanges are higher than their historical averages, currently at about $200 million a day. And there isn't so much Tether flowing out of exchanges. There's always some uncertainty in this because a lot of Tether is often put into a cold wallet, although it's still under the control of exchanges when it is. But even taking this uncertainty into account, we believe that there's an increase in balances of Tether on exchanges. So what is that Tether doing there? Well, it's not yet being traded. And that's really interesting. It suggests this Tether is sitting there as dry powder waiting to purchase cryptocurrency. But how can we tell that this Tether is waiting? Well, we can compare the ratio of Tether that is traded for every Tether that is received on chain. And over the 200-day average, it's been about 22 Tether being traded for every one that was received on chain. But in the last 14 days, on average, there's just been 10 Tether traded for every one that's received on chain. And so suggests that actually there's a lot more Tether sitting there waiting to be traded than is actually being used in the markets at the moment. And this perhaps is not surprising. There's been a lot of Tether issued recently. But what I also find surprising is that that issued Tether has not actually saturated demand for Tether. How can we get a handle on that? Well, we can look at the velocity of Tether on the blockchain. We're looking here at the amount of time that Tether was held before it was sent on again. And actually, there's been an increasing amount of Tether that's been held for less than 2 weeks before it's been sent on. And that suggests that people are really demanding Tether and its velocity is increasing. So in summary, in terms of what's been happening on chain this week and its relation to the markets, well, Bitcoin has seen both a big price increase, but also large inflows to exchanges. And that suggests that there's strong demand, because otherwise we might see the prices fall as those inflows came in. It does look like some profits have been taken in fiat. So some people decided that actually they think prices are where they're going to be for a while, or perhaps they just think they need to balance their portfolio and take some cash now. And while there's been a lot of Tether issued recently, it does seem that the demand remains. But for me, there's a big question. What is going to happen with all the Tether that is currently sitting on exchanges? And that for me is a key question to look at over the next week. So I hope to discuss that with you again when we return. Over to Teana.
Hi, I'm Teana Baker-Taylor, and thank you for joining us for Governance and Guardrails, our segment where we talk about legal and regulatory issues affecting digital assets. I'm delighted today to be joined by Stephen Palley, the infamous advocate and healthy skeptic of digital assets. Stephen, thank you so much for joining me today.
You're very welcome. I'm glad to be here, and I'm glad to be infamous too.
Yeah, absolutely. Where are you today in the world?
So I'm in a suburb of Washington, D.C. called Chevy Chase. It's inside the Beltway. So if you're familiar with D.C., I'm about 6 miles or so from the White House, which is much more detail than you asked for, but what the heck?
No, that's okay. Just as long as it's not too much detail so that people can find you. So today we're going to be talking about a recent decision by the Ninth Circuit Court of Appeals in the U.S. Some of you may remember the story a couple of years ago about Thomas Costanzo, hope I pronounced his name right, who was convicted in 2018 for selling Bitcoin for dollars, unfortunately to some federal FBI agents who were posing as drug traffickers. Yes, oops. So he was sentenced to 41 months in prison, which makes perfect sense to me on the face of it because he was clearly laundering money, or so it would seem. He was convicted using a federal AML statute, and he's appealed the verdict. So I think the first thing, Stephen, can you give us a sense of, for those who aren't in the US, state versus federal jurisdiction, who is the Ninth Court of Appeals, and what Costanzo's appeal actually argued?
Yeah, absolutely. So the United States is a federal system. We've got states and we've got the federal government. And way back in the 18th century when the United States was formed, there was basically states were, you can almost think of them as separate and individual countries. Yeah. Initially, they were gathered together in something called the Articles of Confederation, which was too loose. And then there was a constitution. And we're actually, sort of as a sidebar, seeing some of that tension now between the federal and state governments in response to COVID. Like
definitely, right? Yeah.
There's a doctrine in the United States called the doctrine of co-equal sovereigns, which basically says that, for the most part, the states and federal government are equal. They're equal governments with equal power. That is not true for constitutional purposes when it comes to things like entering into treaties. And there's we don't really have time for me to talk about the Supremacy Clause. But just sort of suffice it to say, states and federal governments are co-equal sovereigns, and they've got their own different sets of of laws.
Okay.
States generally have something called they've got a police power, which allows them to control or set laws to govern things like marriage, sort of intrastate or inside state health, safety, and well-being. So in order for a federal criminal law to be implicated, you have to implicate one of the federal government's powers. And most frequently, interstate commerce has been, under the Commerce Clause of the Constitution, has been the way that federal criminal statutes have been justified, which brings us finally to the case that you asked me about. And I think you asked me to explain what the Ninth Circuit was.
Yeah, please.
Okay, so the American courts, the federal courts, which are separate than state courts. So we've got federal court system and a state court system. Federal courts are divided into really three levels. There's some nuance to that. There's arguably a fourth, magistrate judges, but from constitutional purpose, you have federal district courts, which are the trial courts. You then have circuit courts of appeal, which are made up of different federal districts, and then you've got the Supreme Court. So if you lose in district court, you take an appeal to the federal circuit where you're located. There's like my constitutional law professor would probably like mark me down for leaving out some nuance and details, but that's basically the way it works.
We're looking for context, so that's okay.
Right. So like the Ninth Circuit Court of Appeals is the court that governs, or is the Court of Appeals you take an appeal to if you're out on the West Coast. And there's some states that are not exactly on the coast that are part of it too, but so California, for example, if you lose in federal court in the Northern District of California, which is in San Francisco, which is where a lot of technology litigation happens, you would then take an appeal to the Ninth Circuit. And that's basically, I think I answered your question. I rambled on.
Yeah, no. So let's dig into this a little bit. So on the face of the evidence, Costanzo appears guilty, right? He had a high profile on local Bitcoins. He was dealing in huge amounts of money, $15,000 to $50,000, huge to some people. And as I understand it, federal agents had been investigating him for a number of years, right? And they told him that they were going to be using the Bitcoin that they bought from him to facilitate drug trafficking. Right. So all of this is sitting within the evidence, and he gets convicted. But I think what is interesting here, and I would like you to explain why this is interesting, is we have federal agents looking into the sale of something that appears to be happening interstate. So typically the FBI doesn't get involved unless you cross state borders, right? And this is where these interstate laws are coming into play when it has to do with the exchange of Bitcoin for dollars. Am I right there?
Well, sort of, yeah. So this guy got convicted under federal anti-money laundering statute, which is, for all of you lawyers out there, that's 18 U.S.C. section 1956. And this fella who had a profile on local Bitcoins under the name, I love this, Morpheus Titania.
Oh, yeah.
You think somebody watched The Matrix, maybe? And he also, his profile said it was Bitcoin was the honey badger of money and the most fearless currency with no regard for national borders anywhere and protected by encryption.
Okay.
Not protected by from stupid, though, apparently.
Right.
So this guy, he, agents reach out to him and say they want to buy Bitcoin. And at various points they say, we're going to use it to buy drugs. And he's like, I don't need to hear about that. That's okay. Also, as an aside, that you don't, but you don't want to know. That's known as, that's the doctrine, that's willful blindness, and that doesn't usually work. Anyway, he gets convicted, and whether or not he should have been or whether or not the law is just is a different conversation. He gets convicted and he takes an appeal to the Ninth Circuit from his 42-month sentence in federal prison. He says, you didn't prove that this is something that happened in interstate commerce. Basically what happened was this guy, the agent gave, in one instance, the agent Klepper was his name. I'm looking at the opinion. Gave Costanzo $13,000 in cash. Costanzo transferred Bitcoin to the agent to his phone.
Okay.
Is the way the court describes it. The next month, this happen again. And what Costello said was, he was like, look, there's no interstate commerce nexus. This was peer-to-peer from one phone to another. So therefore, you didn't prove interstate commerce nexus necessary to apply the statute. And the Ninth Circuit said, look, I mean, it might have been what you call peer-to-peer, but you sent communication over the internet. And there's pretty well-established law that says using the internet can create an interstate commerce nexus. And what's more, we understand that this thing, Bitcoin, it's recorded on a blockchain, which exists everywhere in the world. And to me, I didn't think the analysis was that hard to get to if you're familiar with sort of the jurisdictional, the case law on jurisdiction. But it is really interesting, in my mind, to realize that in the court's view, and it took maybe a page or 2 pages to reach this conclusion, the court's like, no, Bitcoin, the very nature of a Bitcoin transaction is that it implicates interstate commerce. Now, if you think about it and you spin the thread out, if I pay somebody $25 to mow my grass, right, there's no interstate commerce nexus, right? I'm giving you greenbacks, filthy fiat, stinky fiat covered in cocaine and blood. But nonetheless, I'm giving you money, and
But that's issued by the federal government, right? So is the instrument.
But that doesn't matter from an interstate or intrastate standpoint. That transaction, the fact that you use cash, doesn't trigger in and of itself for that transaction federal law. Now, it happens that if you follow it, I think there's a Twitter account called One Law Every Day. If you're creative enough, you can always find a federal law that somebody's breaking. We're probably breaking a law right now, like if we really wanted to dig. But as a practical matter, for in most instances, nobody would think of that as being interstate. It's intrastate. And on the other hand, using Bitcoin, if you spin this court's thread out, it seems to mean that every time you use Bitcoin, you're implicating federal jurisdiction. Now,
so let's say that the federal agent, and maybe you know this, I don't, is in that state. So to make the exchange, potentially, it's done over the internet, could be done over a beer in a pub. You know what I mean? They could both be in the same state. So if you and I are both in Los Angeles and we do a peer-to-peer Bitcoin transaction, we're still within the federal jurisdiction because Bitcoin exists on the internet?
I mean, I guess it would depend on the transaction, and you'd have to figure out whether or not somebody was interested enough in going after you. But as I read this court's opinion, the conclusion seems to be use of Bitcoin to consummate a transaction where the transaction otherwise violates an existing federal law. The fact that you used Bitcoin for the transaction would seem to be enough in some cases to trigger federal jurisdiction.
So is this AML enforcement? Which, I think we all agree we don't want any type of, funds of any kind, whether it be Bitcoin or dollars or, chickens, to be used to facilitate money laundering and terrorist financing, right? That's not good. But is this in response to trying to find a reason to enforce something? Or is this an AML infraction and then looking for the easiest way to put that enforcement into place?
No, I mean, there's no policy reason here for the court's ruling.
Okay.
Courts don't, in the vast majority of cases, courts are not thinking about broader policy considerations. This judge's job was to say, was the burden of proof satisfied? Did the facts meet the jurisdictional nexus for the statute? Yes, they do. Now, under the doctrine of stare decisis, which is a fancy way of saying precedent, this case is now precedent for other courts, trial courts, district courts within the Ninth Circuit. Yeah. So it's binding precedent. Now, it's probably distinguishable on the facts from other cases that are brought before the court, but you can certainly see a future trial court when this issue is being raised saying, well, the Ninth Circuit has The Ninth Circus. I like that. The Ninth Circuit has already told us that Bitcoin transactions take place in interstate commerce.
Okay, so that leads me to my next question, which is, what's the impact? What could this potentially mean for future trading, transmission, for the market overall on the transfer of digital assets in the future? What could this potentially mean? The precedent of this rule.
Well, I mean, what's that?
Hypothesize for us.
Well, we already have a pretty broad, pretty broad coverage by federal law of financial transactions under the 1970 Bank Secrecy Act, which is the thing that governs exchanges. And every state except, I believe, one has their own MSB licensing regime. I don't know that it really changes much for...
Well, in the peer-to-peer space, though, that's largely unregulated.
Yeah. Well, it's funny. Whenever I hear somebody say something is unregulated, my conclusion is that they just haven't looked to see what regulations might apply. And arguably, that's the case here. I don't think this has much impact on financial services in and of itself, because that is already so understood to be so heavily regulated. Mm-hmm. Does it have anything to do? So I guess the question would be, what about non-custodial wallet providers? I'm not sure it has much impact on them either. It's hard to say, honestly. Like, I want to give you an explosive, this will change the world conclusion. I'm not sure that it does. I think it's just it's another brick sort of in a wall of jurisprudence about like what this stuff is and what the transactions are. And a court is saying these transactions appear to happen in interstate commerce. So that would mean that my business transaction with somebody within my state where I use Bitcoin arguably implicates or creates a nexus to federal law, even though neither of us have left the state, simply by use of the use of Bitcoin. Now, the same thing could be said, however, of using a wire. So if I'm in Maryland and I wire money to somebody else in Maryland, I believe this is not something I deal with on a regular basis. I'm not a criminal law guy at this point in my career. That would probably nonetheless implicate interstate commerce and implicate the federal wire fraud statute.
Yeah.
Even though we're both within the same state, because we're using instrumentalities of interstate commerce for the transaction. Same thing with using a telephone or using a computer and internet. So, what's interesting is, new technologies come along and people say, oh, everything is different. The world has changed. Laws don't apply. And this is just an example of how that's not true. The court looks at it and they're like, walks like a duck, sounds like a duck, I guess it's a duck, right? We can always find a way to place things into existing categories.
Yeah, absolutely. And I think that, we hear that time and time again, that we don't automatically need a whole new set of laws to deal with digital assets or to work with them. But sometimes maybe it's the interpretation, and is the interpretation always fit for purpose?
We might need new laws, and laws will develop. They take time. I guess what this does is this belies the notion that, what did he say this was? That this was the most fearless currency with no regard for national borders anywhere and protected by encryption.
Fearless is good.
Fearless is good. And hopefully, whether or not somebody should be spending 3 years in prison for this, I'm not so sure it's a great use.
Not for us to say.
Yeah,
Stephen, thank you so much for breaking that down. I thought that was a fascinating case. And the next time another doozy comes up, we will absolutely give you a ring back and see if you can break it down for us like we've done.
Oh, goody. Had fun.
So how can our watchers get in touch with you should they have any questions for you about digital assets or any other legal interest that they may have?
Sure. So you can reach me via email at spalley, Palley, at Anderson, ANDERSON, feel free to follow me on Twitter. I'm at Stephen D. Palley. I apologize in advance for my bad dad jokes and herring memes, but I do talk about crypto and law in that Twitter feed from time to time. And I write a column for the Block Crypto as well. So
Awesome.
Always happy to hear from folks.
Awesome. Great. Thank you so much for joining us today, Stephen.
Thank you. It was fun.